Let's talk about Caterpillar. Caterpillar is the largest of the US companies in this space. I suppose you could look at others like John Deere and others, but it's a global leader in terms of the equipment that is used in mines, construction, agriculture, power generation. It's headquartered in Peoria, which is in the state of Illinois, somewhere around the middle there near Chicago. Manufactures the yellow equipment that I think everyone is familiar with the brand Cat. But they are also a major supplier of diesel engines, which are used in locomotives, heavy mining equipment, and power generation. So all of those power backup units, if it's a sizable installation, those would be a market leader in that environment. Market capitalization, 43.95 billion US dollars. A high dividend yield of 4.06 and a fairly high, in fact, price to earnings ratio of 22.06. So there is a share chart. I'm quite impressed to see that we've managed to dredge up a share chart of Caterpillar on our ENPS system. It's in the usual pink. But yeah, Wayne, it's been pretty bouncy.
Yeah, look, it's been a tough environment for them. I mean, one thing about Caterpillar, which I didn't really know, massively strong cash generation. Even though their volumes are down and they are obviously suffering from the down cycle in the commodities as well, but their cash generation is phenomenal. They've had 22 years of increasing dividends. So obviously when they say we have a progressive dividend policy, they stick to it, not like our mining companies, and they can obviously afford to stick to it.
Yeah, so very well run company. Douglas Oberhelman is the CEO. They've got global production.
Yes.
They have global distributorships, not always themselves, like here in the Sub-Saharan Africa region, they sell through Barloworld.
Yeah.
They've got a broad range of stuff. They say that their equipment is cheapest through the cycle. So, you know, what that means is that when they sell a contract, for example, for a big digger, that the equipment lasts a long time, that they have a maintenance arrangement. So the number of tons you can use per dollar spent on the equipment is lower, because if you go for something cheap from one of the Chinese or Asian suppliers, those things are going to wear out.
Make no mistake, they have proven themselves to be leaders. But what's interesting is they're also talking restructuring. They've already closed 4% of their global production, and they're going to close another 10% by 2018. And when you read through their financials, and it's quite clear, and it's said quite a few times, they've got inventory problems. They can't turn the stock quick enough. In other words, their production is higher than what their sales are at the moment, and they just don't get enough efficiencies through the system. So hence they're cutting back on production.
Look, it's a pity that that chart doesn't go back a little bit further, because what I can tell you is that if you can visualize for a moment, this is a company that did fine back in the day. But it had a real purple patch from 2005 to 2008, which was where globally all the mines were spending like mad because of Chinese demand. Then they fell in a heap, but they actually came back quite strongly from 2010 to 2013. And it's actually more recently since then that they've fallen from above $100 down to this kind
but
of
I mean, this is
60,
related
70.
to earnings. 2007, 2008 made $6 earnings. 2 years ago made about $4 earnings. Now they're making $3.50 earnings. And in fact, the last 2 quarters of last year, 2015, was actually a loss for them. So, you know, their fortunes are tied to the economic cycle.
But now, you can help me with this. Here's a company that has got wonderful cash flows, pays brilliant dividends, is a very well-run company, is very good at customizing its work process in order to continue. Why don't they get the benefit of the doubt and trade at a consistently high PE even through the tough times? Or is it the market doesn't care?
Market doesn't care about that. Look. They are shielded a lot by their high dividends. They've also had a $2 billion share buyback program. They've got so much money.
I guess that helps.
And that helps enormously. So they are, I mean, the high PE there is obviously on depressed earnings. So the market is looking through. I mean, in South Africa, if your earnings fall, market doesn't look through falling earnings. I mean, they would, in South Africa, this would be at, I don't know, a 12 PE, maybe even a 10 PE type of thing. So they are given the benefit of the doubt there. But, you know, they don't see life getting any better for the next 2 or 3 years, but that's quite normal.
So hot or not? I mean, where's the demand going to come from? Where's the pickup? Do you think the mines are going to start buying again? When? Not for the next 18 months or 2 years.
You can't see much joy here in the next short while. You know, especially on the commodity prices can go up, and the mining shares might do quite well, but they're still cutting back on production. They're going to delay buying anything for a long time.
So the sales uptick in profits for these companies isn't going to come from
it comes later.
Okay, good. So we're not hot on that one.